Hello, hi. I'm Lim Yun, the Chief Investment Strategist of Lion Global Investors. Thank you very much for your time today. As a disclaimer, I'm here today to introduce to you the investment outlook for 2022. This is not a recommendation of stocks, but actually basically to inform investors so that they can actually make better decisions in their investment journey. Next. First, we cannot talk about 2022 or the outlook of the 2022 without taking a look at what actually happened in the past 3 years. So if you look at the past 3 years, the stock market has actually done very well. And it's actually centered on the US market and also on technology stocks. So in this slide itself, if you take a look at the first row, the US market has actually done really well for the last 3 years. It was up around 20% on a year-on-year basis. And if you look at the tech stocks, they have done even better. Last year it did 30%, and that's without, looking at 3 years back, which it did more than 40%. And 2 years ago, it did more than 40% again. So the tech stocks have really done really well. And if you look at Europe and also Asia, they have done relatively well for the last 3 years, except for Asia, which done badly for last year because of the Chinese stock market. Next step. So what are the reasons for that? I think the stock market performances for the last 3 years were driven by 3 issues. First, COVID itself. So the differences in opinion, the differences in performances was due to the progress of COVID and how fast the countries actually exit COVID itself. Second issue, quantitative easing. Basically, for layman, it means that the central banks have been pumping liquidity into the system itself based on 2 things. One is quantitative easing, people call it QE, and second thing is a lower interest rate. So the first 2 items that we have, COVID and quantitative easing, actually causes the differences in performances globally. So COVID, meaning that countries that exit the lockdown earlier actually did better, right? And for QE, quantitative easing, and interest rate, if you look at the US market, they actually did really well, boosted by QE itself. And lastly, why did China do badly last year? I think the reason for that is because China introduced a lot of regulations. And also the common prosperity policies that they've put in place got investors very worried. So I think if you focus on these 3 points, COVID, QE, and on the Chinese regulations, you probably will get the broad directions right this year. And lastly, beyond 2022, there are 3 other longer-term themes that I will not elaborate today. I'll just basically, do a simple one. One which is runaway inflation, meaning that today inflation is really high. Would it continue for a very long period of time? If it does, then it has implications for stock picking. Secondly, is this focus on the environment. So remember COP26, end of last year, basically a lot of countries have put in place pledges, and the pledges are to cut down on carbon emissions and to lower the temperature rise in the whole world. So what that means is that there will be some winners and losers in the decarbonization scheme itself. And lastly, I also want to introduce disruptive innovation, which is a long secular trend. And I think that there are a lot of investment opportunities over there. First, let's look at MSCI World Index. This is the so-called the performance of the stock index for the whole world itself. If you look at the stock, the indices, it's done really well. 45 degrees going up until 3rd quarter of last year. The market saw some volatility. So from September onwards, the market actually dropped, and then it actually bounced around. So what are the reasons for that? It's because of Delta. Because of the Delta variant, people got worried, right? The COVID cases actually became more, and there was actually this lockdown itself. But guess what? The stock market actually recovered despite finding Omicron at the end of last year. And the number of new infection cases actually went up. But despite this, the market went on to rally at the end of last year to reach a new high. Next. And what are the reasons for that? It is because I think the market is actually pricing in a recovery or transition away from COVID into a post-COVID world. And the reasons behind that is very simple. Omicron at this moment, people believe that it's more transmissible, meaning that, you can get it easier, and, that's the experiences in UK, in US, and in Europe, and even in Singapore. But it's less severe, meaning that the hospitalization rate is actually lower, and the chances or the risk of dying from it is actually also lower. And most importantly, the current vaccines that we are taking is actually effective against it. So this chart over here shows, it's a dated chart, right? But end of last year, if you look at this chart, a lot of countries have actually reached a very high level of vaccination. Singapore is around 90%, right? Same as a lot of the developed countries, and even for the emerging countries, you actually see, even at the end of last year, countries like Indonesia, if you look at Thailand, you look at India, the vaccination rate is actually at a relative high level. So going into this year, when the countries actually reach vaccination rate of, let's say, 80, 90%, they will open up. So what this means is that unless we have a new variant that is more potent, that is deadly, which is not our base case, then we should be transitioning into a post-COVID world in 2022. So what that means is that the growth rate for this year, GDP growth rate for this year will still be high because there's actually a recovery. So if you look at 2020, right, the GDP growth rate across the world is actually weak except for China, because China exited COVID much earlier. They controlled it better. They were more effective in controlling it, right? 2021, you see growth rate is actually very, very high. GDP growth rate, right, which is 2021, last year. And this year, there's a continuation of the reopening, and you see the growth rate is also very strong. US, 3.9%, 4% in European Union, right? Even Japan, 2+%. China, 5%, thereabout. And for the whole world, it's around 4+% GDP growth rate. If you look over the last 10 years, these are really good numbers. Next. The second theme that I think investors should actually focus on is this idea about tightening. So what does this mean? It means, for example, in the US, the Federal Reserve is now talking about tapering, right? So what is tapering? Tapering means that they are buying less bonds. But what does that mean? It actually means that the central bankers actually buy less bonds, meaning that there'll be more money in the system itself, So this is what investors call, pumping liquidity in the system itself. So the Federal Reserve is telling you that we have done this in the past few years, basically because of COVID. We are worried that the economy would actually slow down, that there will be unemployment. That's why we are actually doing this. But now, because we are exiting into a post-COVID world, what we are doing is that we don't need this anymore, right? So by April to June of this year, we basically will stop it. So they are slowing down this purchase of bonds, which means that there's less and less money going into the system itself, or new money. And second thing is that the Federal Reserve is also saying that, we will do roughly maybe 3 rate hikes in this year. Rate hikes every time, they say they do a rate hike, it could be 25 basis points or 0.25%. So 3 rate hikes. And for next year, I think the expectation is that they could do another 3 rate hikes. So what this means that liquidity will be tighter in the system. So can you imagine, you are in the past in a virtuous cycle, meaning that you have lower interest rate, you have money coming into the system. So what that does is that stock market starts to go up. You feel richer, you take the money, you might be buying assets like, let's say, property. Your property prices goes up. If you're happy, right, then you buy more stocks. So it's a virtuous cycle. But on the reverse, it's also true. Meaning that if you take money out of the system itself, the stock market might actually correct. Then you feel that, things are not that great. You don't pay so much for a property. And when interest rate goes up, right, it's less affordable to buy an expensive property. So the property prices also comes down. So this has an implication on asset prices. Next. Except for one place in this world, strangely, and that is China. So US is on a tightening. UK, you look at a lot of places, you look at even Singapore, we are on a tightening phase. But China is actually on the loosening phase, right? That explains why China actually partially did badly last year. But for this year and going forward, we understand that China is actually on a loosening cycle, meaning that if the economic growth in China slows down, there's a chance that they would actually loosen further. So end of last year, what did they do? They did things like triple R cut. What does that mean? It means that they lower the reserve requirement at banks, which means that there'll be more liquidity in the system itself. They cut interest rate in China. And actually, our expectations is that they could actually increase bank loan quota. And also, if the economy actually slows down further, they could loosen property measures or even do fiscal spending. Next. So, take a look at this chart over here. The Chinese market actually peaked out earlier last year. February, thereabout, if you look at this chart itself, and it has been on a downward slide. Just now I mentioned that, it's actually quite tight over there in China, but there are also new regulations put in place. Remember, Ant Financial, it was supposed to be listed end of 2020, right? Then you have things like anti-monopoly laws. Alibaba got fined, early of last year. TT Choosing got, their applications actually got banned in the phones itself. And then even online games, right? Minors, meaning people below the age of 16 or thereabout, you are limited to a certain number of hours of playing per week. So what does that mean? It means that a lot of these tech stocks in China are facing new regulations. Profitability probably will drop, and share prices have actually dropped. So the investor sentiments there in China is actually quite bad. And what are the reasons for this? I think the Chinese government is actually, they have actually announced it, right? They have said that we want to have this common prosperity policy. It's not something new. In actual fact, China is a planned economy. I think Singaporeans will probably understand this better than Western commentators. So Western commentators say, oh no, China is actually going back on capitalism, right? They will say, oh, they are going back to the communist roots. No companies, private companies can now not earn a good profit, and as such, China is not investable. But we don't think so. I think what the Chinese are doing is that they are playing a long game. They've already told you, right? During their 14th five-year plan, they said, we're going to double our economy in 15 years' time. And what do we need to do? We need to balance, we need to balance the economy so that there will be more equitable growth for everybody and more sustainable growth. So what does that mean? It means that they want the growth to be more equal. There'll be more equality, right? And they want a sustainable growth. So what are things that they have done? They want to prevent, let's say, for example, a bubble in the property market, which is what most governments will want, right? So they put in place the 3 red lines. Basically, what it does is that it forces the leverage among the developers to be at a reasonable level. Secondly, they want to focus their attention on certain, let's say, technology like semicon, AI. These are the technology that will actually benefit them in the long run. And thirdly, they want to clamp down on bad behaviors, like for example, anti-monopoly, right? If you have monopolistic kind of behavior, it's bad for everybody. So we think that there are short-term volatility in the Chinese stock market, but in the long run, if they solve the long-term issues within the economy itself, they probably will get equitable, sustainable growth, and that will be good for the Chinese market. Lastly, that's just now I've actually mentioned the 3 main points or the 3 drivers of stock market for this year itself. But what are the other themes that investors are thinking of? The first one, like just now I've actually earlier mentioned, is inflation. So inflation is high, right? Last year, inflation in US, 7-8% on a year-on-year basis at end of the year. Singapore also relatively high. People worry, is this inflation going to continue? We say that inflation is transitory depending on the time frame that you have. If you focus on last year, inflation rate is going to be much lower this year, but it still be relatively high. The reasons are 2. This slide over here actually shows you oil prices. High energy prices was one of the key driver of high inflation last year. But we think oil prices probably is around this level, 80 plus level. The reason behind that is because the OPEC countries do not want oil prices to escalate $100, $150. If that happens, then it incentivizes the shale producers to come back into the market. It will also incentivize the renewable energy producers to produce more. So in order to safeguard their own interest, they will keep oil prices at a high enough level, which is at these levels that we are, but not too high. So we think that energy prices would not continue to be a driver of high inflation this year. Next. Second thing, obviously, right? With COVID, it means disruption, which means that, supply chains are disrupted, people are not working, factories slow down, containers do not move. And as such, there's a supply shock. So meaning that prices actually goes up. But the reverse is also true, right? If we are moving in a post-COVID world, things are going back into normal, people go back into factories, there's no more chip shortages, ships start to move around, prices will come down. Next. So here, we actually summarize it. There are two short-term factors that actually caused high inflation last year. First is the supply chain disruption. Second is high energy prices. These are short-term factors that will reverse this year. But I also want to caution everybody that in the long run, there will actually be three long-term structural factors that will drive inflation higher, meaning that this year inflation will taper off, but going forward, the long-term inflation will be higher than pre-COVID times. So which are the three factors? One, deglobalization, right? So now countries after COVID realize that you have to do some manufacturing in-house, right, for the components, for medical supply, so that you do not rely on one country alone. So what that means is that it's less efficient, prices goes up. Second thing is technology becoming more monopolistic. Remember, 2-3 years back, if you go to Taobao, Alibaba and whatever, Rakuten and what have you, and you buy products over there, there's huge discounts. But these days, the discounts are getting smaller. So in a way, technology is driving less deflation in the system now. And lastly, of course, China is the factory of the world, and it was actually exporting deflation, meaning that because they can produce things so cheaply, the prices of everything drops over time. But because the population in China is actually aging, so there's actually, and the wages are actually going up. So China produces things that are no longer getting cheaper and cheaper, and as such is exporting less deflation. So these three long-term trends means that inflation will stay high going into in the longer run. The other thing is actually, this focus on environmental issues. So for example, I mentioned about COP26, right? There's a lot of pledges to keep, not to use fossil fuels. So what are the implications? Implications are that some sectors will actually do badly, some sectors will do well. So which are the sectors that will do badly? Power, right? So for example, those that burn fossil fuel to generate electricity, utility companies that, investors love because of the dividend yield. But going forward, they have to invest in renewable energy, right? Which means that there's less net profit for them to share with investors. So some of these sectors will probably not do as well. Road transportation, the gasoline cars producers will not do well. The whole new bunch of car companies and the component companies that support, like, let's say, electric vehicle, right? So these are the new areas to be in. Steel, right, is actually a very dirty industry. It uses coking coal. But there are also beneficiaries, right? Like hydrogen, which is used as a storage. And there's this whole ecosystem of companies that actually support that. Okay, next. And lastly, I just want to highlight a very important theme that investors should be looking out for, and that's disruptive innovation. So over here, I just want to stress that these stocks may actually correct this year because, like I just mentioned, the whole world is reopening. When it's actually reopening, investors might rotate from growth stocks to value stocks. It's a cyclical trade. So what that means is that they'll be looking out for countries with old economy stocks like banking stocks, industrial, let's say airlines, hospitality stocks. And these are the ones that they might be buying this year because valuations there are cheap. But once the valuation gap closes, they will go back to the growth stock. So I actually do not like to use the word growth equals to, let's say, technology. I'll rather look at disruptor. The reason is because there are some technology stocks that will be disrupted by others. So if we think about tech stocks, growth stocks, we should think about the disruptive trends behind them. So over here at Lion Global Investors, we actually have a disruptive innovation fund, and we have highlighted 16 investment themes that investors should look at. I do not have time today, But one theme that I think is transformational for us going forward is Web 3.0 together with metaverse and blockchain. So what does that mean? It means that in the past for the internet, everybody has got a social media kind of identity, but it's different identities for different platforms. Let's say one for your gaming, one for LinkedIn, one for Facebook. But going forward, in the metaverse Web 3.0 world, everybody has only one identity, which is your virtual avatar. It's your identity that you use across everything. Let's say in the gaming, in Facebook, it could be in any other platforms, and use that to work, live, and play. And finally, we cannot talk about valuations we cannot talk about the outlook without talking about valuations itself. So over here, I just want to highlight to everybody that valuations are actually high across the globe in terms of equity. So if you look at the price earning ratio itself, the US is 27% premium to its historical averages, right? If you look at other countries like even Europe, or even China or even Asia Pacific, they are actually trading at a premium. But if you look at the earnings growth for this year, the earnings growth are more measured. So for US, Europe, maybe around 8%-ish, right? Japan, there's a little bit of anomaly because their fiscal year is different. They start from April. But if you look from April of this year towards next year's March, and also around 8% earnings growth, right? Asia, 7-8%, thereabout. So measured earnings growth, but if you look at the valuations, it's actually on the high side, which means that, and just now I've also mentioned, you actually have this reversal of liquidity back into the system itself, and there's this reopening trade. So what does that mean? It means that at least for 2022, the chances are that investors, professional investors included, might actually be more interested in the cyclical markets that have underperformed but are actually reopening. Reasons because earnings is about the same, 7-8%, but the cyclical markets are actually cheaper. So what are the markets? Singapore is one of them. And another one, which is actually, a dark horse, is probably Japan. So what do these countries have in common? What they have in common is that within the indices itself, there are more old economy stocks, right, that will benefit when we actually have a reopening coming back. Lastly, I come to my conclusion, right? There are three drivers of stock performances this year. First, Omicron, right? So the key question that everybody has to ask is Omicron the last major disruption from this COVID itself? We think it is at current data that we actually have. No doubt, there could be more new cases. You actually see new cases shooting up in US, in Europe. There could temporarily be certain lockdowns. In Japan, it's still undergoing lockdown, right? In Singapore, we are trying to open up. Certain times, we close down the VTL itself. So Omicron could still lead to some disruption early part of this year. But our base case is that we will probably all open up into a post-COVID world, meaning that things goes back into normal. Second thing, we think that major markets that benefited from all the excess liquidity coming into the system over the last 3 years, countries like US, tech stocks, probably wouldn't do that well this year. The reason behind that is because the US government is taking away the liquidity from the system itself, and interest rate is actually going up. And lastly, China has done very badly last year. We think the reasons for that is because of their desire to have equitable and sustainable growth. It's a planned economy. So what they are trying to do is that they have a plan, they want to grow, and these are the short-term pains that they are willing to suffer, which they already suffered last year. So this year could be a good year for the Chinese stock market. So in short, my conclusions for investors would be, on the trading call, investors should look at cyclical markets because they have underperformed the market for last year. So markets like Singapore and also for Japan. Second thing, our expectation is that the Chinese stock market will probably rebound this year. But beyond this cyclical trade that investors have, we think that there's this long-term positive and very long-term growth potential with disruptive innovation. Just now, I do not have the time, but there are 16 themes that we have actually identified, of which one, which is the Metaverse and Web 3.0, is a very powerful and transformational theme that will drive the growth of a lot of the growth stocks out there. So this is an area that investors should actually put a lot of effort to study and probably to take advantage of the growth potentials available over there. Thank you very much. I'm Lim Yun, the Chief Investment Strategist at Lion Global Investors.